Imagine you wake up one morning and your bank account is frozen. You can't access the money you worked hard to save. No warnings, no time to prepare. All your money's just gone, or at least out of your reach. It sounds like something out of a nightmare, right? Well, Jim Rickards, an economist and financial expert, warns that this could become a reality much sooner than we think. Rickards is not your typical prophet of doom. His concerns are grounded in decades of experience gained through studying the global financial system and understanding its hidden weaknesses. One of his biggest warnings is centered on the fragile structure of modern banks. At first glance, banks seem like solid, trustworthy, and safe places where your money is protected until you need it. But this confidence is often misplaced. What most people don't know is that banks operate on something called fractional banking reserve. What this means is they only keep a fraction of the money you deposit. The rest, they lend out. This setup works well until it doesn't. Think about a crowded theater. As long as only a few people leave at a time, everything remains orderly. But the moment someone yells, "Fire!" chaos begins, and everyone will rush for the exits at once. In banking, this is called a bank run. When too many people try to withdraw their money at the same time, the bank runs out of cash because it doesn't actually hold enough reserves to meet everyone's needs. This has happened multiple times throughout history, with devastating consequences. Rickards compares these past crises and the systemic risks we face today. He points to the 2008 financial meltdown as an important moment when the world came dangerously close to a total collapse of the banking sector. Governments had to step in with massive bailouts by using taxpayer money to save the failing banks. While this intervention prevented immediate disaster, Rickards argues it set a dangerous precedent. He warns that the next time this happens, governments may not come to the rescue. Instead, they might resort to a method called bail-in, which is far more harmful to people who save every day. Now you might ask, what is a bail-in? Well, unlike a bailout where the government pumps money into banks, a bail-in shifts the burden to the bank's customers. Simply put, it means the bank uses the money in your account, which is your hard-earned savings, by the way, to stabilize itself. If you think this sounds unfair, it's because it actually is unfair. But this isn't just in theory. It has already happened. In 2013, during the Cyprus banking crisis, the government froze accounts and seized a portion of depositors' money to rescue the failing banks. People woke up to find their life savings slashed without warning. Rickards believes this could also happen in larger economies, like the United States or Europe. If a major financial institution fails, the government might give priority to saving the system instead of protecting individual depositors. And if you think your money is insured, consider this. Most deposit insurance schemes only cover a portion of deposits, and in a large-scale crisis, even those guarantees could collapse under pressure. But the risks don't stop there. Another danger Rickards talks about is the growing trend of negative interest rates. Imagine that, instead of earning interest on your savings, you're charged a fee for keeping your money in the bank. It sounds weird, but this policy has already been implemented in countries like Japan and some parts of Europe. The idea is to encourage people to spend or invest their money instead of hoarding it. While this might actually stimulate economic activity, it's terrible news for savers. Over time, your account balance will shrink, taking with it the value of your savings. Negative interest rates lead to a larger issue, which is inflation. Inflation is just like a slow leak in your car tire. You don't notice it immediately, but over time, it can leave you stranded. When central banks print money to stimulate the economy during a crisis, what they end up doing is flooding the system with currency. This reduces the value of the money already in circulation, meaning your savings will buy less and less. Rickards warns that during periods of high inflation, keeping money in the bank is like leaving it out in the rain. It will steadily lose value. There's also the digital frontier. Banking has become increasingly reliant on technology, and this has made our financial systems vulnerable to cyber attacks. Rickards has raised a scary scenario. What if hackers targeted major banks or payment networks? A well-coordinated attack could disrupt services, freeze accounts, and even destabilize economies. Even though banks invest heavily in cybersecurity, the fact remains that no system is foolproof. Despite the convenience of the digital nature of modern banking, it also opens the door to unexpected attacks. Rickards has also warned about the central bank digital currencies CBDCs. These are digital versions of national currencies controlled directly by the central banks. On the surface, CBDCs promise efficiency and convenience, but Rickards isn't convinced as he sees a darker side to this. With CBDCs, governments could track every transaction you make, monitor how you spend your money, and even impose restrictions. Imagine living in a world where your financial privacy is gone, and your access to funds depends on whether your spending aligns with government policies. That's a level of control that should make anyone uneasy. These risks might feel distant or merely theoretical, but Rickards insists they are closer and realer than we think. During the Great Depression, thousands of banks failed, and people lost their life savings because there was no deposit insurance at the time. More recently, in 2015, Greece imposed strict capital controls during its financial crisis. Citizens had to be limited to withdrawing just a small amount of cash each day, and this left many unable to cover basic expenses. These events show that when push comes to shove, the system will always prioritize its survival over the needs of individuals. So, what can you do? Rickards isn't advocating for panic. Instead, he's urging that we take practical steps to protect ourselves. Rickards suggests that you keep a portion of your savings in cash, stored securely in your home. This will ensure that you have immediate access to funds during a crisis. He also recommends investing in tangible assets like gold and silver, because these assets are not tied to the banking system and have also retained their value for centuries. Diversification is another strategy you can consider. By spreading your wealth across different asset classes like cash, precious metals, real estate, and other investments, you reduce your exposure to any single point of failure. Rickards also advises against keeping large sums in a single bank, especially if that bank is heavily involved in risky activities. Rickards' message is about being aware and staying prepared. The financial system, as it exists today, is complex, interconnected, and highly vulnerable. From bank runs and bail-ins to inflation and cyber attacks. Taking proactive steps can help you safeguard your financial future and avoid being caught off guard when the next crisis hits. The question you need to ask yourself is simple. Are you willing to trust that the system will always work in your favor? Or are you going to take Jim Rickards' advice and prepare for a world where it might not? The choice is yours, and it could very well be the difference between financial security and uncertainty in the years to come. If you found this video helpful, don't forget to like, subscribe, and share it with someone who needs to hear this.